Stop, right there. Before you scroll, before you swipe, before you do anything else, I need exactly 60 seconds of your attention. Because what happened in the silver market over the last 48 hours? It is the kind of thing that happens maybe once in a decade, and if you miss understanding it today, you might spend the next 5 years wondering what exactly went on when you had the chance to be right in the room when it happened. Silver, one of the oldest forms of money known to mankind. A metal that has been traded, fought over, smuggled, hoarded, and worshipped across civilizations for literally thousands of years. A metal that powered the entire global economy before paper money even existed. A metal that today is baked into every solar panel, every electric vehicle battery, every AI data center chip, every single piece of technology that the modern world depends on. And today, on February 17th, 2026, that same metal is sitting at around $74 an ounce, down nearly 40% from where it was just 3 weeks ago. Now, before you think, okay, so prices fell, big deal, that happens, let me stop you right there. Because this is not a normal correction. This is not the market taking a breath. This is not profit taking. What you are watching unfold right now is a story involving the world's largest economy going completely dark, a $1 trillion evaporation of wealth, a US Treasury Secretary pointing fingers live on national television, and a liquidity vacuum so severe that Bloomberg had to describe it as the market struggling to find a floor. Stick with me, because by the end of this video, you are going to understand something that most people, even people who follow markets every single day, have completely missed. And that understanding, it might be the most valuable thing you walk away with today. Let's go back, not years back, just 12 months back. January 2025, silver was sitting at $30.20 an ounce. Respectable, stable, boring even. The kind of asset that financial advisors mention once and then move on from. Nobody was making viral content about silver. Nobody was staying up late watching silver price charts. It was just there. Fast forward to January 27, 2026, silver touched $111.68 an ounce. Let that land for a second. In 12 months, silver went from $30 to $111. That is a 270% gain in 12 months on one of the most ancient established commodities on the planet. Not a meme coin, not a startup with no revenue, not some speculative biotech bet. Silver, the thing your grandmother's silverware is made of. And then, on January 29, 2026, silver did something that shocked every single trader on every trading floor on every continent. It hit an all-time high of $121.64 per ounce. $121.64 per ounce. The highest price silver had ever achieved in all of recorded human financial history. Now here is where this story gets interesting, because you might be wondering, what on earth caused that? What force in the universe pushed silver from $30 to $121 in the span of a single calendar year? And the answer to that question is the foundation of everything you need to understand about what is happening right now today in February 2026. The reasons were not random. They were not speculative nonsense. They were structural, fundamental, and this is the part that matters, they have not gone away. The first reason was supply, or more precisely, the catastrophic lack of it. Between 2021 and 2025, the global silver market ran a cumulative deficit of approximately 820 million ounces. For context, that is nearly a full year's worth of every silver mine on Earth running at full capacity. Every ounce mined in an entire year and then some was consumed faster than it could be produced for 5 straight years, and nobody in the mainstream media talked about it. Nobody made it front page news. It just quietly happened like a slow leak in a pipe that nobody noticed until the ceiling started collapsing. The second reason was demand, not jewelry demand, not coin demand, industrial demand, the kind that cannot be switched off because entire global industries depend on it. Every solar panel needs silver, every electric vehicle contains silver, every AI server rack, the ones powering every major artificial intelligence system right now, the data centers being built at a pace the world has never seen before, every single one of them contains silver. And demand for all of these things was not slowing down. It was accelerating exponentially. And the third reason, the one that lit the match on an already powder keg market, was China. January 1st, 2026, New Year's Day. While most of the world was nursing hangovers and watching fireworks replays, Beijing made a quiet, understated announcement that sent shockwaves through global commodity markets. China, the country that controls an estimated 60 to 70% of the world's silver refining capacity, might announce that it was implementing a new licensing regime for all silver exports. Effective immediately, now this was not technically an export ban. China did not say we are stopping all silver exports. What they said was far more sophisticated and arguably far more powerful. They said, from now on, if you want to export silver out of China, you need a government-issued license. You need to be a state-certified company producing at least 80 tons annually. You need a credit line exceeding $30 million, and ultimately the government maintains full discretion over whether your license gets approved and how much silver you actually get to export. In practice, this effectively placed around 121 million ounces of refined silver that would normally flow freely into global markets, under direct Chinese government control. To understand why this matters, imagine you live in a city with 10 grocery stores, 9 of them are owned by the same company, and that company just announced they are going to decide day by day whether they feel like selling groceries or not. And the remaining one store does not have enough stock to feed everyone. That is what happened to the global silver market on January 1st, 2026. And the market responded, slowly at first, then all at once. Silver prices climbed through January, fed by a combination of short sellers getting squeezed, industrial buyers panicking about future supply, retail investors piling in through social media buzz, and institutional money recognizing that something historically significant was happening. By January 26th, silver crossed $100 for the first time in history. By January 29th, it hit $121. And then the other shoe dropped. Here is a detail that most people reporting on this story have completely glossed over, and it is arguably the most fascinating piece of the entire puzzle. Inside China, there is, or was, one single fund available to ordinary Chinese retail investors that allowed them to invest directly in silver futures. One, just one. It was called the UBS SDIC Silver Futures Fund, and in the weeks leading up to silver's historic peak, this fund became the focal point of a speculative frenzy that Chinese financial regulators simply could not contain. The fund's premium, meaning how much above the actual value of its underlying silver holdings it was trading for, has climbed to 36%. Think about what that means. Ordinary Chinese investors, desperate for a way to get exposure to the silver rally, but with very few options available to them, were paying 130 sidors for every $100 worth of silver they were actually getting, because there was literally nowhere else for that capital to go. And the frenzy was being supercharged by social media, by messaging apps, by the same dynamics that drove GameStop in 2021, but at a scale and on an asset class that affected global industrial supply chains in a way GameStop never could. The fund manager issued risk warnings daily, sometimes multiple times a day. The warnings got more urgent with each passing week. The elevated premium is unsustainable. Investors could face significant losses if the market suddenly turns. Every warning, ignored, because the price kept going up. And when the price keeps going up, warnings sound like noise. The Chinese government watched this with increasing alarm, and they intervened twice. First on January 22nd, and then again on January 30th, the Shenzhen Stock Exchange issued emergency full-day trading halts on the UBS SDIC Silver Futures Fund. The official statement, issued in Mandarin, said the fund would be suspended from market open to market close. 4 separate oil investment funds were also halted the same day. The message Beijing was sending was unmistakable. We are pulling the handbrake. This stops now. And when China yanked those levers, the global silver price responded violently. From its all-time high of $120 on January 29th, silver began a freefall. By early February, it had crashed through $82. Bloomberg reported that silver lurched between losses and gains, dropping nearly 10% before snapping back, as a lack of liquidity led to wild swings in a market struggling to find a floor. And in total, the combined gold and silver market crash erased an estimated $1.28 trillion in combined market value in a matter of days. $1.28 trillion gone. February 10th, 2026. Fox News, Sunday Morning Futures, US Treasury Secretary Scott Bessent sits down for an interview, and he is asked about the extraordinary volatility in precious metals markets. And what he says is pointed, deliberate, and historically significant. The gold move things have gotten a little unruly in China. They're having to tighten margin requirements. So gold looks to me kind of like a classical speculative blow-off. A speculative blow-off. Those 3 words coming from the United States Treasury Secretary are not casual conversation. A speculative blow-off is financial terminology. It describes a market driven to extreme heights by speculation rather than fundamentals, and then experiencing a sharp, rapid reversal as that speculation collapses. The most famous example in precious metals history was the Hunt Brothers silver squeeze in 1980. Another was silver's spike to $50 in 2011. Bessent was not just describing what happened. He was explicitly pointing to China as the source. He highlighted the UBS SDIC Silver Futures Fund, the one that was trading at that 36% premium, as a specific example. He described Chinese retail and institutional leverage as having reached a breaking point. Now, whether you interpret that statement as fair, accurate, or politically motivated depends on your perspective. But what is undeniable is this. The US Treasury Secretary of the United States went on national television and blamed the world's second largest economy for destabilizing global precious metals markets. That is not a routine thing to say. That is a significant diplomatic and economic signal, and it told markets something important, that this situation was not going unnoticed at the highest levels of the American government, which brings us to right now, today. Today is February 17th, 2026, and today is the Lunar New Year, the year of the horse, according to the Chinese calendar, has officially begun. And that means something very specific for the silver market. The Shanghai Gold Exchange, SGE, which is China's primary physical gold and silver wholesale market, is closed. Officially, per their own published announcement, the market closed from February 15th and will remain shut through February 23. The Shanghai Futures Exchange, SHFE, where silver futures are traded on the Chinese side, is also closed for the same period. All Chinese equity markets, commodity exchanges, and financial institutions are shuttered. They reopen February 24th. That is 8 days of complete silence from the world's single most influential participant in silver markets. Now here's the question you should be sitting with, and I want you to really think about this before I answer it. When the biggest buyer in the world goes silent, what happens to prices? You might instinctively think prices go up because there is a supply shortage, but that is not how short-term market mechanics work when the largest buyer steps away. In the short term, in the days and weeks while that buyer is absent, prices fall because the sellers are still there. The traders in London and New York who want to book profits are still there. The hedge funds that went long on silver at $50 and are sitting on massive gains, even at $74, are still there. The ETF investors who bought into the rally and are now hitting stop losses are still there. But the massive countervailing force of Chinese physical buying that was previously absorbing all that selling pressure? Gone. On holiday, celebrating the new year. The market right now is experiencing what traders call a liquidity vacuum. The technical definition, a period in which there are significantly more willing sellers than willing buyers, causing prices to drop rapidly on relatively small volumes. Because when there are not enough buyers to absorb selling pressure, every sell order moves the price more than it normally would. Spreads widen. Volatility explodes. The price chart starts to look like an ECG of someone having a very bad day. Saxo Bank's commodity strategist Ole Hansen described the situation precisely. China, he noted, had been a key engine behind the month-long rally in precious metals and selected industrial metals, and would remain closed through February 23rd, potentially limiting additional upside in the near term. That is the polite professional version. What is actually happening is that silver is in genuine price discovery chaos. Traders in New York are trying to set the price of an asset whose biggest influencing market is completely offline. It is like trying to determine the fair value of rice when the entire Asian continent has stepped out for lunch. You are left with whatever the remaining participants are willing to pay, and right now, those participants are nervous, cautious, and still scarred from watching $1.28 trillion disappear in January. Several gold and silver ETFs have declined between 2% and 4% in recent sessions. This mirrors weakness in futures markets and signals that even institutional investors, the so-called smart money, are in risk-off mode, locking in whatever profits remain rather than pressing new bets. Let me step away from the data for a moment, because I think the most important thing to understand about what is happening right now is not the numbers, it is the psychology. Markets are not rational machines. Markets are made of humans. And humans, when they are uncertain, do not make calm, calculated decisions. They panic, they herd, they follow momentum. They sell when things are falling, not because selling makes logical sense, but because watching something fall triggers a primal fear response, the same response your ancestors had when they heard a predator in the bushes. Move now. Ask questions later. What the silver market is going through right now is exactly this. The narrative changed. 3 weeks ago, the story was silver is going to $200, supply crisis, China, AI, solar, buy, buy, buy. That narrative attracted capital, enormous amounts of capital. Money poured in from retail investors who had never bought silver in their lives, from pension funds adjusting allocations, from hedge funds chasing momentum. And then the narrative flipped. Suddenly, the story became, this was a bubble. China is cracking down. The US Treasury Secretary is calling it a blow-off. The exchanges are shutting down. And with that narrative shift came a stampede for the exits. The same psychology that drove prices to $121 on the way up is now driving them toward $74 on the way down. Herding, panic, fear. Data analyst Mike McGlone captured this dynamic visually when he noted that silver's stretch versus copper and crude oil, when it surged above $100 an ounce in January, represented its greatest ever stretch relative to those comparable industrial metals. A top signal, he called it. Because when an asset runs that far, that fast, that far ahead of everything around it, eventually something has to give. And yet, This is the part of the story that I find genuinely fascinating. The underlying reasons silver ran in the first place have not changed, not even slightly. Let me be very clear about something. The supply deficit is still there. 5 years of cumulative 820 million ounce deficits do not disappear because a fund in Shenzhen got suspended. The solar panels still need silver. The EV batteries still need silver. The AI data centers being built right now, this week, this month, with hundreds of billions of dollars in capital, they still need silver. Those industrial demands do not care what the price is doing on the COMEX on a Tuesday in February. China's export licensing regime is still in effect. The restriction that placed 121 million ounces of annual refined silver under government oversight was not reversed. It is still there, still functioning, still creating a fundamental constraint on global supply that did not exist before January 1st, 2026. The structural deficit is still real. Analysts across the board expect 2026 to mark the 6th consecutive year of global silver deficits, 6 years in a row where the world consumes more silver than it produces. The U.S. government's designation of silver as a critical mineral, the official recognition that silver is now a strategic national resource, not just a commodity, that is still in place too. That designation happened in late 2025, and it fundamentally changed how Washington thinks about silver supply security. None of those things evaporated when the market crashed from $121 to $74. Not one of them. So what you are watching right now is a market that got extremely overheated, extremely fast for real reasons, and is now going through a painful but necessary cooling off. The correction is real. The temporary pain for anyone who bought above $74 is real. The fear is real. But the question, the big, important, historically significant question, is whether the underlying story is real. And the data says yes, it is very real. And here is the most telling signal of all. German precious metals refining group Heraeus, one of the most respected voices in the physical silver market, noted that even through all this volatility and correction, the silver market is still showing tightness in China, with futures in Shanghai being in backwardation. For those unfamiliar, this means that the spot price today is higher than the futures price for delivery in the future. It is one of the most reliable signals in commodity markets that physical supply is genuinely tight. People need silver now, and they are willing to pay more for immediate delivery than for a promise of delivery months from now. That is not a bubble signal. That is a structural physical shortage signal. And it is still present, February 24th, 2026, 1 week from today. That is when the Shanghai exchanges reopen. That is when the liquidity vacuum ends. That is when the world's largest physical silver market plugs back into the global price discovery system. And the question hanging over every precious metals trader on the planet right now is, what happens then? There are two schools of thought. The first school says China comes back, sees silver at $74, and views it as an extraordinary discount relative to the structural realities of the market. Chinese industrial buyers, manufacturers of solar panels, EVs, electronics, who were squeezed out of the market during the speculative frenzy of January, suddenly find prices they can actually afford. Physical demand surges. Prices stabilize and begin recovering. The rally resumes, but this time driven by real industrial consumption rather than speculative excess. Analysts who hold this view point to the $65 per ounce level as critical support. If silver holds above $65 on a weekly close, the bull thesis remains structurally intact. The second school says, when China comes back, the narrative of the bubble has burst is now so entrenched that even Chinese buyers approach the market with more caution. The 36% premium fund is a cautionary tale. The government margin hikes are a warning. Beijing has made clear it does not want speculative frenzy, and so China's return is measured, gradual, and does not provide the explosive buying surge that bulls are hoping for. The truth, as it almost always is, probably lies somewhere between those two poles. What is certain is that when February 24th arrives and those red and gold lanterns come down in Shanghai and Beijing and Shenzhen, when the traders walk back into their offices and the terminals start lighting up, the silver market is going to have its first real test of whether this correction is a pause or a reversal. I want to zoom out for a second, because there is a bigger picture here that goes beyond silver, beyond China, beyond Lunar New Year. What is happening in the silver market in early 2026 is a microcosm of something much larger. It is the collision of two forces that are going to define the next decade of global economics. Force number one, the green energy transition and the artificial intelligence revolution, two of the most capital-intensive, resource-hungry technological shifts in human history, happening simultaneously, both requiring silver at a scale that existing mine production simply cannot match. The solar industry alone is projected to require silver volumes that, if sustained, will consume more than the entire annual global mine output within a few years. And AI data center infrastructure, the silver and copper demands being generated by the race to build AI capacity, are staggering in scale. Force number 2, China's strategic resource calculus. Beijing watched the West weaponize financial systems, dollar dominance, swift exclusion, asset freezes, as geopolitical tools. And China responded by doing something the West failed to anticipate, positioning themselves to control the materials the global green energy transition cannot happen without. Rare earths, cobalt. And now, formally and explicitly since January 1st, 2026, silver. This is not accidental. This is not coincidence. This is a deliberate, long-term strategic repositioning. The licensing regime that Beijing implemented on January 1st is not a temporary measure. It is intended to remain in place through at least 2027, possibly much longer. What this means practically is that every solar panel manufacturer, every EV company, every AI hardware supplier in the world that is not based in China now has to think about silver supply chain security in a way they have never had to before. And that anxiety, that structural, existential anxiety about whether you will have enough of a critical material to keep your business running, does not take a Lunar New Year holiday. It compounds, quietly, every single day. Before I wrap this up, I want to share one historical parallel that I think is genuinely instructive. 1980, the Hunt brothers' silver squeeze. Two Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, decided they were going to corner the silver market. They accumulated enormous amounts of physical silver and silver futures contracts. Silver went from around $6 per ounce in 1979 to $50 an ounce in January 1980, the then all-time high. And then, when regulators changed the rules and raised margin requirements dramatically, the Hunts could not cover their positions. Silver crashed from $50 to $11 in a matter of months, catastrophically. Does that sound familiar? The parallel is not perfect. The Hunts were a small group of individuals deliberately trying to corner a market. The 2026 situation involved a much more distributed speculative frenzy, amplified by social media and messaging apps, operating within a globally connected financial system with Chinese government intervention rather than American regulatory intervention. The scale is incomparable. But the psychology, the mechanics, the sequence, parabolic rise, speculative excess, regulatory intervention, violent correction, that sequence has played out before. And history notes what happened after the 1980 Hunt crash. Silver did not recover to $50 for over 30 years. It took until April 2011, driven by quantitative easing and a post-financial crisis commodity boom, for silver to briefly touch $50 again. Now, and this is the crucial difference, in 1980, there was no structural physical deficit, there was no solar energy industry consuming silver at industrial scale, there was no AI revolution, there was no China implementing strategic export controls on silver as a critical national resource. The speculative excess in 1980 was purely speculative, built on nothing structural. The speculative excess in early 2026 was built on top of genuine, real, structural fundamentals that remain entirely intact. Whether that makes the recovery faster and shallower than 1980, or whether the regulatory crackdowns create a prolonged consolidation period anyway, that is the debate happening in every major bank, every commodity research desk, every hedge fund strategy meeting on Earth right now. And nobody knows the answer with certainty. So let's bring it home. Here is what you now know, having made it to the end of this breakdown. You know that silver ran from $30 to $121 in 12 months on the back of real, structural, fundamental reasons. Supply deficits running 5 years deep, explosive industrial demand from solar and AI and EVs, China's strategic export controls, and global monetary policy dynamics all converging at once. You know that a speculative frenzy built on top of those fundamentals, particularly in China, where retail investors poured into the only available silver fund, driving it to a 36% premium while ignoring daily risk warnings, created conditions that were mathematically unsustainable. You know that Chinese authorities intervened twice in January, halting that fund, raising margin requirements on their exchanges, and triggering a violent market correction that erased $1.28 trillion in combined gold and silver market value in less than 3 weeks. You know that the US Treasury Secretary went on national television and characterized the whole episode as a speculative blow-off driven by unruly Chinese trading activity, the most senior American economic official explicitly naming China as the destabilizing force in global commodity markets. You know that right now, as of today, February 17th, 2026, every Chinese market and exchange is completely dark until February 24th. Creating a liquidity vacuum that is piling additional downward pressure on silver prices that are already deeply corrected from their highs. And you know that the structural realities, the supply deficit, the industrial demand, China's export controls, the critical mineral designation, the 6-year running shortage, none of those things changed. Not one of them. The market went from pricing in the best possible outcome to pricing in the worst possible outcome in less than 3 weeks, as markets tend to do. Whether you look at this situation and see a buying opportunity, a warning sign, or simply a fascinating case study in the psychology of financial markets, that is a decision only you can make for your own situation, with your own due diligence and your own risk tolerance. But one thing is certain, this story is not over, not even close. When China wakes back up on February 24th and its factories and exchanges reconnect with the global market, what happens next will be one of the most closely watched events in precious metals history, because whether prices surge back, stabilize at these levels, or continue lower will tell us something fundamental. It will tell us whether the 2026 silver rally was a speculative bubble that is now permanently deflated, or whether it was the first dramatic, chaotic, painful chapter of a much longer and much more serious story about a world quietly running short of one of its most essential materials. Stay curious, stay informed, and stay skeptical of anyone who tells you they know for certain what happens next. Because in a market this complex with this many moving pieces, certainty is the most expensive thing you can buy. If you found value in this breakdown, if this helped you understand something complex in a way that feels real, then please consider subscribing. Hit the notification bell so you are here when China reopens on February 24th, because we will be breaking it down for you in real time. The market never sleeps, and neither do we. Stay sharp. See you in the next one. This video is for educational and informational purposes only. The information shared here reflects publicly available data and news as of February 17th, 2026. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. Precious metals markets are highly volatile. Past performance is not indicative of future results. Always conduct your own independent research and consult with a qualified financial advisor before making any investment decisions. The creator holds no responsibility for financial decisions made based on this content.